Lisa, I'm going to start with you. We've been sort of listening and watching what the Fed had to say yesterday. Does that change your calculus at all?
We're still, Andrew, cautious on the U.S. equity market. And if we look at what came out in the FOMC minutes, that really reinforces the view. Certainly, they are resolute on combating inflation. And while they acknowledge that at some point they're going to have to decelerate, they're really still emphasizing the fact that they're looking for that data dependence, that clear and convincing evidence that inflation is coming down really before they're willing to move away from the current move towards more restrictive policy. So that being quite a big headwind and the signs that we see of the economy decelerating, those are, again, leading for us to have a more defensive outlook at this time.
So what does that mean? Are you sitting in cash? What to the extent you're buying things, what would you be buying?
We're advising really right now our clients to stay less emphasizing on U.S. equities, so underweight what normally would be their strategic allocation. And instead of that, we would actually emphasize moving more into high-quality fixed income and also global infrastructure. And really the reason for the interest in those latter two areas is simply because they offer some very nice diversified cash flows that really can provide more of a buffer in an uncertain economy.
Carrie, what do you think? Did the Fed minutes surprise you?
Hi, Andrew. I think the one aspect of the Fed commentary we found particularly interesting is that the 75 basis point as a continuing percent increase may be a little higher than the Fed had expected. Now, we believe that there'll be another 75, but perhaps then move to 50 basis points. And we know that there is some effect in the economy. We've seen the impact on interest rates, of course. And we also are noticing that as companies report, they've been saying, well, perhaps we need to freeze employment. Numbers were okay, not great in the quarter. But Amazon, Facebook, Google, many of the tech companies have focused on cost control and either saying they're freezing headcount or perhaps cutting back. That's true of a lot of startups, a lot of high-tech companies. And so that's going to have an effect on employment. It might not be this month, but it's going to be soon where we're seeing that trickling through the system. And that implies to us the economy really is slowing down, that they've had an effect. The market is down 10% from its peak, not down 20% anymore. But when the market falls further, if it were, we saw plenty of buyers. There are buyers, there are investors, and when we're selling at 16 times earnings, forward earnings. So we think that it's sensible that we have some consolidation right here. The market moved up very quickly, but buying stocks that have earnings that seem visible at prices that are reasonable to us makes a lot of sense. Names like AMT, Carrie, Adobe. Right. Yeah.
Well, I was just going to say, before we get into the names, you heard what Lisa had to say. I mean, in terms of underweight, overweight, in terms of just how you're sort of weighting the situation, she would be underweight equities in the United States on a relative basis to, I think, where she might otherwise be. Is that the way you would play it, or no?
Not really. I think we're more aggressive about U.S. equities, particularly where they had fallen to. The market definitely was oversold on June 16th. We thought valuations were very attractive for many names. The U.S., we believe, is still a better place to invest right now than overseas. And so, no, I don't think we'd agree. I understand we need to be cautious because there are all of these unknowns about earnings, inflation, interest rates, the war, China. But the price was telling us that it was time to put some money back to work, for sure.
So, Carrie, real quick, when you say certain stocks are cheap, name them, but also, what is the multiple at which you think is fair value these days?
Yeah, well, the market right now is selling at about 18 times forward earnings, assuming that those numbers are going to come down some. And if 3% on the 10-year seems to be about a top, it's not getting above that again. We think that's reasonable. If it comes down a little, yes, we would be more aggressive. 18 times earnings is not a multiple that is cheap, but definitely not an expensive multiple for this interest rate level. So PayPal is 18 times earnings, and they're committed to cost control. I think that stock can go higher. Amazon fell, it was underperforming for the last year or so, started to outperform. We like that here. O'Reilly Auto, CRM on the tech side. We believe with employment as it is, people are using much more of the cloud and using their CRM systems. Makes sense here. It's stock to underperform. I mentioned Adobe, AMT. How about Booz Allen, defense contractor? That's having a good year, but we also think it can go higher from here.
Shepard Smith here. Thanks for watching CNBC on YouTube.